Hello all. Today I will going to be start with SY BCom third semester Business Economics. So let's start with module number 1 for SY BCom third semester, chapter number 4, trade or you can say business cycle. So let's start with introduction of trade or business cycle, or you can say definition or meaning of business cycle or trade cycle. Cyclical fluctuations are characterized by alternating waves of expansion and a contraction. They do not have fixed rhymes, but they are a cycle in that the phases of contraction and expansion recur frequently and in fairly similar pattern. Business cycles are upward and a downward movement in output, prices, interest rate, employment, profit, and a real income, where the trade cycle or the business cycle is a part of the economic system. The terms trade cycle has been defined in various ways of different economists like St. Keynes, Samuelson, etc. So according to them, that Professor St. he explained that cyclical fluctuation are characterized by alternating waves of expansion and contraction. They do not have fixed rhymes, but they are the cycle in the phases of contraction and expansion. Whether John Maynard Keynes, he explained that a trade cycle is composed of period of goods trade characterized by rising prices and a low unemployment percentages alternating with period of bad trade characterized by falling prices and high unemployment percentages. Whether Samuelson he explained that a business cycle is a swing in total national output, income, and employment, usually lasting for a period of 2 to 10 years, marked by widespread expansion or the contraction in most sectors of the economy. So let's start with features or characteristic of business cycle or trade cycle, which is classified by two different categories. The firstly, fluctuation in aggregate economic activity, and secondly, expansion and a contraction. Now let's start with explanation with this first point, fluctuation in aggregate economic activity, where the trade cycle are fluctuation in the level of aggregate economic activity rather than fluctuation in a single specific economic variable. It involves changes in many variables such as employment, investment, profit, as well as financial market variable leading to changes in gross domestic product. Secondly, the expansion and the contraction, where I am going to explain first with expansion and then I will going to explain with contraction. The trade cycle are accompanied by expansion and a contraction, which is also known as a recession also. The important characteristic of an expansion are rising consumption, production and real GDP, where during expansion, consumption expenditure rise sharply as businessmen react with raising production, real GDP raises. As a consequence, business investment in plant and machinery also rises sharply. Second, increase in employment. The demand for labor increases during expansion. This leads to higher employment. Rise in prices, where as the demand for goods and the material rises, their prices start rising. This may be accompanied by rise in wages and prices of services. Hence, prices tend to rise during expansion. And lastly, rise in profit, demand for credit and stock prices, where the business profit rise sharply during expansion, anticipating this stock price rise as investor expect a business upturn. Since the demand for credit rises sharply, the interest rate may also rise during expansion. But at a time of contraction, I will going to explain that falling consumption, production, and real GDP. During the recession, consumer purchase declined sharply while inventories of consumer durable increased unexpectedly. Next, increase in unemployment at the time of contraction, where the demand for labor fall during contraction. This is followed by layoff and higher unemployment. Falling prices as the demand for goods and the material decline, their prices tumble. Wages and the prices of services are not likely to decline, but they tend to rise less rapidly during economic downturn. And at a time of contraction, fall in profit, demand for credit, and the stock prices, where the business profit fall sharply during recession on the anticipation of the stock prices usually fall. Since the demand for credit fall, the interest rate also fall during recession. Now I will going to explain right now the with phases of business cycle or trade cycle. The ups and downs in the economy are reflected by the fluctuation in macroeconomic variables such as GNP, investment, profit, prices, employment, wages, etc. The variation in this show different phases of a trade cycle. Generally, expansion and a recession are only two phases in a cycle, but considering the intermediate stage between, there are various phases, but the four different phases are there. The first one, which is known as prosperity, or you can say boom, or we can say expansion also. The second phase, we can say recession. The third phase, which is also known as depression, or you can say contraction also. And the last phase, we can say recovery, or you can say revival also. So let's start with the diagram explanation of different phases of business or trade cycle. Now in our y-axis, it shows here the level of economic activity, and in our x-axis, which is known as a horizontal axis, where we can observe here the number of years are there. Now you can see there is a fluctuation, or you can say wave-like movement from up to down and again from down to up. Okay, this is a cyclical fluctuation. Okay, with the help of four different phases are here. With prosperity, we can say boom or expansion. Second is known as a recession. Third is known as a depression, or you can say contraction also. And lastly, we can say revival, or we can say recovery. Okay, so let's start with the boom, or we can say prosperity here. This is your first phase, where the increase in output, employment, investment demand, profit, bank, loan, prices, standard of living, etc. are the main features of the phases of prosperity. We can observe the following important features during these phases, where the bank credit grow rapidly even though rate of interest is higher. There is general expansion of credit. Idle funds are channelized into productive areas since stock prices are higher due to high profitability. Money supply increases and it continues to flow in all kind of economic activity. And lastly, excess capacity gradually disappear, creating shortage of labor and raw material. Second phase, I will going to explain, which is known as a recession. Now, what means by recession here? That will be your second phase. I will going to explain that the recession is a period of contraction or slowing down of economic activity. This phase begins when the downward process in the growth rate become rapidly and output, employment, prices, etc. register or decline. The growth rate may still remain above the steady growth line. Recession is generally of a short duration. After the peak in some section, the demand starts declining. the existing production thus become excess and investment result into overinvestment. As a result, future investment plans are given up which lead to fall in demand for input. This ultimately causes demand recession. During this phase, business profit fall. This lead to fall in share prices due to lack of investment opportunities. The demand for bank credit fall. This lead to a fall in the rate of interest, employment, investment, income, and a demand decline. Recession may be mild or severe. This severe recession might lead to a sudden crisis arising out of the banking system or the stock exchanges. If recession continues for a longer period of time, when the investment reduces to a very low level, ultimately this reaches to a period of full depression. Next phases, we can say here depression or you can say contraction. At the time of depression is a period of low economic activity. Growth rate goes below the steady growth. There is considerable reduction in production, employment, income, investment, demand and a price during this phase. Bank deposit and a credit shrink due to general decline in economic activity. Investment in stock become less profitable and least attractive. Business profit would be low or even negative. At the depth of depression, all economic activity touch the bottom point called tough. This depression may be short-lived or it may continue for a longer period of time, but gradually the limited forces are set in motion which tend to bring this to an end. And the last phase we can explain here, which is known as recovery, or you can say revival also. Now, various exogenous and endogenous factors are responsible for reviving the economy. Where the economy enter the phase of recovery, it register an upward trend in output, income, employment, etc. But the growth rate may still remain below the steady growth rate. There may be replacement of semi-durable goods or capital stock which will lead to an increase in demand. To meet this increased demand, investment and employment increases. As a result, output and income also start to rise. Over a revival start, the process becomes cumulative. It should be noted that in the early stage of recovery phase, output increases without proportionate increase in the total cost due to excess capacity in the economy, but later cost rise and output become less elastic, which may result in a rise in prices and a profit. Business optimism exists as the recovery takes place. This trend to raise the demand for bank credit, which lead to credit expansion when the cumulative expansion of income, employment, consumption expenditure, investment, prices, etc. exceed the steady rate, the economy enters the phase of prosperity. Now I will going to explain when control of trade cycle or business cycle, where a trade cycle not only harm business activity but also human being by creating unemployment and poverty. Therefore, stabilizing the economy is important to prevent such harmful effect. Stabilization broadly means preventing the extreme of up and down in the economy without preventing the possibility of economic growth. The two most important and widely used economic policies to achieve economic stability are monetary policy and fiscal policy. So let's start with monetary policy. Even though trade cycles are not purely a monetary phenomenon, they are aggravated by monetary factor. The central bank uses various instruments such as bank rate, open market operation, statutory liquidity ratio, cash reserve ratio, selective credit control, etc. to change the volume of money supply. to reduce money supply during the expansionary phase when the price level is rising and vice versa. And the last way we can explain fiscal policy. In a fiscal policy, through taxation and a public expenditure, help to overcome wide business fluctuation. During depressionary phase, fiscal policy may be used to increase aggregate demand to the full employment level by reducing taxes and increasing public expenditure. Similarly, during inflationary situation, taxes have to be raised and expenditure reduced to reduce aggregate demand. Fiscal policy operates as compensatory policy which keep economy close to its full employment level. The personal income tax, public expenditure, and the social security measures may operate as automatic stabilizer. Thank you to all of you.